All right, well, let me start for a second and talk a little bit about myself. In 1993, I went to work for a New York life insurance company as an agent. When I was pretty young, I lost my parents tragically the same day, mother and father at the same time. So I didn't have the luxury of going to college or getting an education, so I had to hit the ground running and start taking care of myself. So I worked for New York Life from 1993 through 2003. In 2001, I discovered just by accident that New York Life had been concealing death benefits from widows and orphans on life insurance policies by omitting the existence of certain benefits from their claim forms. So I brought a class action lawsuit against the company in 2001. It was settled in 2003. 4,198 policyholder families received benefits because of me, and that's where I got the idea that the company that I was representing really wasn't all that it was cracked out to be. And it made me begin to question everything that I saw with a number of insurance companies, a number of strategies I've been saw being sold or promoted in different avenues. The same year in 2003, I discovered that my largest holding, it was an offshore currency trading fund called Tradex, was a Ponzi scheme. And I had $1.6 million in the fund when it went up. And I had to get back to work. So in 2004, January, I started my current company, Wealth Management International. And 95% of our practice has been the uncovering, research, due diligence, and the assistance in prosecution of frauds and misrepresentations on the senior or the investor client. So I come from a different perspective. I'm essentially a turncoat, someone who used to be an insurance agent selling this stuff, although I never sold a life settlement or a Viatical or an offshore life insurance policy. But I recognized when I started my company in 2004 that I really had to have very broad and also deep knowledge of these various financial instruments that affected financial planning, estate planning, asset protection, if I was going to be any good at what I was doing. So what I'll be talking about today is some of the economic and non-economic benefits of domestic and foreign life insurance policies, how they contrast, some of the benefits of offshore products, and there are a number that are legitimate. Although I'll also be covering some of the cons or the perils of these transactions, where there's a number of problems with these things that's often either not explained or played down by the professional advisor to cause the investor to enter into the transaction so they can make the commission, they can make the deal, get management fees. And as you are probably aware, life insurance and annuities pay among the highest commissions of any financial product you could buy in the industry. All right, so first of all, let's talk about some of the good things. So benefits of offshore life insurance, it's also known as private placement life insurance, is that the policy cost may be lower than domestic retail policies. So when you go to a New York Life or a MetLife or a Prudential and you buy a policy, you're paying retail. The commissions on those policies to the agents generally are between 75 and 150% of the first year premium that are paid for those policies. So it explains to you just how heavily front-loaded they are. So that has to be made up by higher insurance charges and other policy costs to recover that for the insurance company, which can take sometimes several years. With offshore policies, they're structured more like boutique investment products, creating your own policy. Typically, premiums have to be at least $500,000 per year for at least a few years. So typically, you have to have a couple $1 million or more in premiums paid into the policies to make them attractive for the offshore insurer to issue the contract and go into business with you. But once you're in, the expenses can be far less than what you'd have for the cost of insurance and other issues. However, these policies are often designed as high cash value and very low death benefit policies to minimize the insurance charges. So they're used more like investment products than they are used as insurance, where you're risk shifting, or if someone dies, there's a tremendous increase over what was paid in premiums paid to their beneficiaries. All right, so also another benefit of offshore policies that you cannot do with domestic insurers is you can pay your premiums other than in cash. In other words, if you've got appreciated real estate or portfolios that can be either collaterally signed or pledged, the offshore insurer will often accept that as premium payment, so no actual cash has to trade hands. But keep in mind that if that occurs, and that asset which is being used to pay the premiums for the foreign policy contains a built-in gain or a capital gain, the capital gains tax is recognized that moment that the premium is paid or that it's collaterally assigned, because it's essentially constructive receipt by the offshore insurer. Also, you're able to invest in asset classes that are prohibited by U.S. insurers. So typically, U.S. insurers only allow you to invest in mutual funds, stocks, and bonds that are inside those funds. They don't typically allow hedge funds or exotic investments that you may want to take advantage of, or in certain currency funds, arbitrage funds. Offshore insurers will typically work with you and design a portfolio that has those asset classes in it. So that's another attractive feature where you have broader investment options than you would have onshore. Also, lastly is asset protection. Whenever an asset is physically outside the United States, it's more difficult for a creditor to get their hands on it or for a court to often get jurisdiction over it unless the ownership of that asset is a U.S. taxpayer. So if you're living in California as I do and you have an offshore life insurance policy and I own it in my own name or my living trust, which is revocable, me thinking that I have any meaningful asset protection probably is not a good bet to gamble on, because the reality is that a U.S. judge is going to say, turn over the asset to your creditor, you lost the case. And if I've got control over it and I don't do that, then what might happen? I might be held in contempt of court, put in jail if I don't cooperate, and who wants to be in that situation? So I'll be talking about that a little bit further as well. This is just kind of my overview slide, but I'll be going a little bit deeper into each subject for you. If there are any questions along the way, if you could just jot them down, and at the end we'll have time for questions, and that way I can flow, because I actually have quite a bit to cover in my limited amount of time. Also, let's talk for a second about some of the basic requirements of life insurance that you may not be familiar with. Typically, most life insurance agents are not, and those who promote these plans don't often know some of the requirements that make an insurance contract insurance for U.S. tax purposes. First of all, to be considered life insurance under the code, the Internal Revenue Code, the contract has to meet the definition of life insurance under the law, which is Section 7702 in the subsections. There's actually a slide or two in here which actually has those references. So as I mentioned, code sections, you're welcome to take them down, but you'll see that they're going to be in later slides, or even maybe further down this slide. However, there's a requirement. Just because you meet 7702 doesn't mean that the tax-deferred growth that normally is enjoyed by life insurance policies will occur. You have to also meet you have to meet the cash value test and also the premium test. So there's a corridor test, and the corridor is the difference between what you paid in premiums and what they pay when you die. If the difference is too small under U.S. law, it will not be considered to be life insurance, and you're taxed every year on the growth inside the contract. However, the death benefit is still tax-free. The other test is the premium test, which is how much insurance did the insurance company receive on day one from, let's say, the 70-year-old insured. If he's got an 84-year life expectancy, that's a 14-year difference. How much money do you need to provide the death benefit actuarially in 14 years? That's called the premium test. So those are the two tests. You have to qualify under one or the other to be life insurance to get the tax deferral, which is the main reason most people buy life insurance policies for investment purposes, certainly private placement offshore life insurance policies. Also, as I mentioned before, if you meet the definition of life insurance under local law, which you can see at the end of the first line there, let me stop for a second. Local law does not mean where the insured lives. It means where the insurance policy is issued from, the domicile of the insurer. So, for example, in Liechtenstein, their laws are far more lenient than the United States. I'll give you a contrast example. In the United States, if you're, let's say, 60 years old, you might have to have a 2.5 or 3 times death benefit relative to the premium paid. If I paid $100,000, it must be at least $250,000 to $300,000 of insurance. Otherwise, the IRS will say this is not a life insurance policy, it's an investment contract. You're taxed every year on your investment return. In Liechtenstein, it can be as low as 1 or 2% over your premium paid. So when you pay in $100,000, only $1,000 or $2,000 of insurance. Is that really insurance? Well, what are the charges on the policy? The charges on the policy are typically, after a year or sometimes less, equal to the death benefit. So there's no risk shifting. You're not shifting a risk to the insurance company where if you die prematurely, they lose anything. Maybe they lose a de minimis amount in the first year. So that's a real issue to look for with offshore policies. If the death benefits don't meet the U.S. definition and tests, then while they may be considered life insurance under foreign or local law, they may very well be disqualified and probably will be disqualified under U.S. law. Also, a modified endowment contract, which is a policy which violates these rules, you can't take the money out of the policy in the form of a loan and avoid the income taxes. So there's two issues here. The first issue is if you don't qualify under the cash value or the corridor test or the premium test that I mentioned a moment ago, your annual returns are going to be taxable whether you take the money out or not. If you do qualify under those tests, but the policy still has too much money accumulated in it over time, it's a 7-pay test, there's also a shorter pay test. These are all tests that can be done by an actuary and that are done by U.S. insurers. They're not always done or done properly by foreign insurers. So you can have a problem where you can't get the money out of the policy without having to pay ordinary income taxes on the withdrawal. And typically the wealthy client might say, well, I don't plan to need this money ever again, it's for my family. But situations change. Look at 2008 when the market slipped. People who were worth 60 million are now worth 30 or 40 million, which still sounds like a rich person, but their lifestyle now dictates that they need to access this cash now, or it wasn't forecasted. All right, there's a couple of other simple requirements. First of all, any life insurance policy issued before 1984 must pass either the cash value, probably after 84, the cash value or the corridor test, which I mentioned before, which is Code Section 7702A. Also, variable life insurance policies, the ones that are most common for offshore or private placement policies, must also meet the diversification requirement under 817H of the Internal Revenue Code, which means that you can't buy a single stock or single investment, and typically you have to have no more than certain percentages. It's a complicated test, but there's a safe harbor in various asset classes. Now, there's a look-through rule. Like, for example, if you bought a hedge fund, and the hedge fund was internally diversified, that might meet the diversification requirements. You may actually only own one or two holdings, but those holdings own 30, 50, 70, 100 or more different securities that are internally or diversified. Okay, there's also the issue of premium tax. A lot of the promoters fail to mention that the premium taxes that you avoid in the states, like in California, I think it's 2.35% of the premium you pay to an insurance company is the state collects in the form of a premium tax, which increases the internal cost of the policy, which is passed on to the insured or the policy owner. However, there's a foreign excise tax of 1%, and certain U.S. jurisdictions actually have lower than that excise tax, which you avoid by staying on shore, which and actually the next slide covers it. Alaska and Delaware have a premium tax of 0.1 or 0.08, so it's a fraction of the foreign excise tax you pay whenever you go from an offshore taxpayer to any offshore jurisdiction. Also, many U.S. companies now offer private placement policies, so you can do some of the same things we talked about here, although I don't believe they'll accept premiums other than in cash. I've never seen any U.S. company do that, but they will allow you to keep the cost down. It's called institutional or private placement life insurance. I think MetLife and a few other companies have Prudential, I think, also has a product or had a product. So you can sometimes accomplish some of these benefits staying local with a U.S. insurer that you know that's highly regulated, and there's a higher comfort level, at least along the U.S. client. So the bottom line is that going offshore may cost more. All right, so some of the perils of life insurance. This is where I'm going to get a little bit more in depth on some of the schemes that I've seen from my clients and maybe you've heard of, either in the news or maybe come across your desk or a client's brought to you and said, what do you think about this? Several offshore life insurance companies offer what's called frozen cash value policies. A frozen cash value policy is a policy where it's designed to hold the investment asset classes that the client wants, stocks, hedge funds, whatever it might be. However, the policyholder is not entitled to any growth in the contract. The cash value is frozen on day one. So you put in a premium, let's say $5 million, and the next day the policy is worth $5,100,000. The $100,000 of growth is not accessible. If the policy doubles or triples in value over time, which could certainly happen with a good market run-up, that growth is not contractually available. You cannot have it. Typically, the contracts I've seen have a loan provision. You can borrow a portion of the premium back. The ones I had one case with Credit Suisse where you could take out 75% of the premiums, as long as there's no decrease in value from day one. So if the policy lost $1 in the market, you lost the ability to get any of your money back. That was a policy I had with a client of mine where, I'll talk about it in a couple of slides, where I was able to recover all of his money with one letter, no lawyer. And it was a $5.6 million transaction. The several prominent life insurance law firms claim that these policies are U.S. tax compliant. And they often are not. And even when they're, by the level of the document compliant, as my warning indicates in the bottom of the slide, there's no U.S. court case or IRS opinion memo which says that these policies are recognized as valid insurance contracts. If you recall the Liechtenstein example I gave a few minutes ago, where you had about a 1% increase over the premiums, and they called that life insurance. You can imagine what a U.S. judge might do when the taxpayer goes into court and says, but it's a life insurance policy, Your Honor. So wait a second. You put $5 million into the policy. There was $5,100,000 of insurance. You pay them $102,000 in management fees in the first year. Where's the risk? Where's the insurance? Insurance is, as you can imagine, is defined as you pay a premium, for someone assuming a risk that they'll lose money if you put in a claim. There's no potential for loss unless the person dies the next day, and now there's a small incremental benefit over what was paid in premiums. So I have a very low confidence level that a U.S. court would evaluate that type of policy, and that was my Swiss Life example, and it was Liechtenstein where that policy was issued from. The law firm in that case is a firm you would know, it was Baker McKenzie. So these are major, well-respected law firms saying this is designed to qualify as life insurance. However, Baker McKenzie was smart and so was Swiss Life. In that case, they actually had a prohibition in the contract against something called the investor control doctrine, which I'll be talking about in just a second. But also they had an indemnity clause, which my next bill I think talks about. They're saying we make no representations or warranties that this will qualify as life insurance in the U.S. code. And if it doesn't, you can't sue us, you indemnify us, your heirs can't sue us, your agent and assignants can't sue us. You'll never see a clause like that in a domestic U.S. life insurance company's product because it's compliant. They aren't saying, and if it's not our problem. So it's really a buyer beware. If you think about it, what is a company like Swiss Life doing? This is the largest pension provider in Europe as far as I understand. So you've got a major, well-respected, financially solvent company, a well-respected multinational law firm selling a transaction that probably won't work. Why? They do it for the money. And they give you a disclaimer and say, hey, we told you that there's no guarantee. It may not work. And you indemnified us, so we're not responsible, so go away. So when you see clauses like that in insurance policies or in offering memorandums, it's a big red flag. And you probably want to run and say, please remove your foot from my door. I'm not interested in talking to you any longer. So investor control prohibition. Is anybody here familiar with what investor control doctrine is? Okay, it's a very important doctrine which is blown most of the time in these offshore policies or any private placement insurance contract. But typically this is a problem that I've seen with practically every offshore policy. And that is the IRS has deemed and won in court in every case I'm aware of since 1986 from the research I've done, there's been dozens of cases, that if you influence it, if you control it, you own it for tax purposes. I don't care if it's in a trust or if it's in a life insurance policy or a foreign annuity. If you are in any way directly or indirectly influencing the investments of that insurance policy, it's yours. And you have to pay taxes every year as if it was sitting in your brokerage account down the street. So the policies that you'll often see will say that they're U.S. tax compliant by their design. And they might be. If they meet every definition under 772 of life insurance and the other related sections, it doesn't mean that if the investor says, well, hey, I'm investing in this hedge fund with my buddy at the country club, can I put the shares into the fund? What's just happened? You just violated investor control because now the investor is controlling or dictating what investment specifically the insurer is making inside the policy. So you can't beam an asset into a policy and expect it now to be considered life insurance and get the tax deferral that life insurance typically enjoys. So again, it can be direct or indirect. Even just an oral agreement saying, hey, would you buy this stock? Would you accumulate just Microsoft shares in my policy? And again, you're violating the diversification rule as well. So the second point kind of makes the point that I was talking about. There's a couple of private letter rulings at the bottom of this slide, which if you want I can send to you if you just send me an email after the presentation. But again, even in oral representation, now the question is how do you prove what was said? Well, if you see that all the investments that are being owned by Mr. Smith's offshore life insurance policy are the identical ones in his IRA in stateside, probably a good indication that there was an agreement. If there's an audit or there's an investigation by the IRS and someone says, well, he told us to buy those investments. Or you see an investment company set up by an offshore life insurance company which is only buying very specific securities that company has never bought before and only for your client's policy. These are other issues that could be evidentiary or indicative of the fact that there was an oral or implied agreement. So really, for this to work, and it can work and it can work very well, the client has to say to the insurance company, you choose the investment manager, and I would like to invest in these kinds of investments. That's fine. You can say, I'd like to invest in stock. I'd like to invest in hedge funds. I'd like to invest in biotech. That's all okay. You just can't say, now go buy this fund or this security or buy or sell here and there. The insurance company has to unilaterally select the investments, make them available to you like a menu, and then the investor or the client can allocate among those investments. The same you have with any U.S. variable policy, whether it's an annuity or life insurance policy. So there's another requirement as well, which which is that the investment must further not be available except for through the purchase of the life insurance policy. So in my Swiss Life example that I gave you earlier with my client, this is a California client, he had a buddy at the country club who ran a biotech hedge fund. And he said, hey, I've got millions of dollars in your fund. I want to put it in this offshore life insurance policy. There's some way we can do it. He said, sure, we'll issue a different class of shares that are not available otherwise. But if you think about it, it's a look-through. You've got a situation where the exact same investment's been made by the same exact money manager at the exact same time. It's not truly a segregated account, which is only available through the purchase of the investment. So there's an argument the IRS would have if he had been audited that it didn't qualify as under investor control doctrine. It also further didn't meet this test, which is, there's a couple of revenue rules that I mentioned there, which speak to the issue, is that it has to be an investment that it's designed by the insurer, and you simply said, I want to put 10% in that one, or 100% in that one, whatever it might be. And so you got to be very careful when you find out that a policy has investments that are not wholly selected independently by the insurer, to say, are these investments available to purchase the same securities, the same money manager, the same investment style at the same time? Same exact investment, same performance, except but for in this policy. If it's available on the outside, it violates the Internal Revenue Code section rules, and you have a problem again with the investor control issue. Now, going back to my earlier point, which is the punchline, is that what happens if you violate investor control? All the gains on the policy are going to be taxable every year, and it's still life insurance, so the death benefit will still come back tax-free, but if you think about it, the death benefit is going to be pretty small in these examples, especially over time, if these investments do well. You're getting forced out and paying taxes every year. Now, there's another issue. When you have money forced out of a life insurance policy, it's ordinary income, no capital gains. So the capital gains treatment that you would normally have, unless the policy is deemed to be a sham and they say, no, you just own those individual securities, may also incur a ordinary income tax as well, which could be pretty bad. Depends on the nature of the investment. All right, so most offshore life insurance policies are not designed to be U.S. tax compliant. They're oversold, and there's a few different examples I can think of where they constitute tax shelters. Here's one. These are all things that I've come across in my practice. One was a case where captive insurance companies were being set up for casualty losses, insuring a building or loss of business use for a company. Those are all legitimate uses, and if you meet the requirements in the U.S. Code, you're fine, and the foreign captive has some advantages as to cost and flexibility. So that's not the import of my talk. However, many of the offshore promoters have told the purchasers of those policies, the customer, we can then issue a life insurance policy to you for your estate planning purposes or for your asset protection purposes. And the problem with that is that life insurance is not tax deductible. So in a couple of situations where life insurance may be tax deductible. One that comes to mind is if it's a casualty risk. If you're an actor in a movie and the film is being produced, and it's a multi-million-dollar film, and Johnny Depp is your actor and he gets hit by a bus in the middle of the film, then the studios has a casualty loss because they couldn't finish their film, they lost money. That would be deductible under U.S. tax law as being a necessary business expense for insurance, for a casualty insurance issue. But Johnny can't buy that policy to pay to his wife and kids when he dies for estate tax purposes. So if you've seen schemes like those where they're claiming, look, your deductions to your captive are tax-free, now those are tax-free dollars. Take that money, now we'll buy a big life insurance policy, and you bought the policy now with pre-tax dollars, which makes it much cheaper for you, and it's offshore, and enjoys whatever the benefits the promoter is espousing. Another tax shelter that I've come across recently is one where a business owner is approached by the promoter, and they say to the business owner, hey, you could sell your business to this offshore life insurance company. They'll pay you fair market value for the company. And typically your seller and buyer get together and they obviously would agree to this. And then the offshore company will issue a life insurance policy with those sales proceeds back to you. Now, it meets the definition of life insurance, every qualification under 7702, let's say it's diversified, it meets the U.S. definition of life insurance in every possible way. What's wrong with that transaction? Does anybody know? Violates investor control because it's his business in it. Essentially, he influenced what the policy was going to invest in. He was investing in his business. So it's not such an obvious thing if you think about it. But if you realize that if any place down the chain, if the investor is influencing what goes into that life insurance policy, other than cash for premiums, or the investments are being selected in any other way, it probably violates the investor control doctrine, And you can count on, if that client gets audited, them losing that battle with the IRS and potentially being subjected to not only, well, certainly taxes and interest, but potentially penalties as well. I mentioned point 3 earlier about the indemnification issue. So when you see a policy where they're saying to you, we're not responsible, et cetera, again, that's a good indication you should run. Now, there's also a fourth risk, which is the risk that the offshore company is actually a sham, and that it's a company designed in such a fashion to where you're never going to get the money back, even if everything goes fine with the investments, because it's being used for personal uses or being used in Ponzi schemes where you have the person who's first in is typically the first out who gets their money back, but the later insureds find that the fund isn't there, the funds aren't there. There was another case that I wanted to quickly just touch upon in that arena. I'll come back to it actually in a couple of minutes. Are there any questions so far? This might be a good place because we're going to change topics in just a moment. Anything I haven't covered that someone has a burning question about? Okay, that's good. Either I'm doing a good job or you're just waiting for it to be over. Okay, so there's a couple of tax qualifiers that are kind of new requirements. There's the Foreign Account Tax Compliance Act, which you may have heard about in some other sessions at this presentation. There are greater reporting requirements and due diligence on investors of certain types of financial accounts. So there also may be withholding as well, tax when you have money in an offshore jurisdiction or in some of these investments. Cash value life and annuity policies are financial accounts. So it doesn't just mean a bank account or a stock brokerage account. Life insurance and annuities, it didn't used to be this way. The IRS wasn't clear years ago. They clarified it a few years back and said, no, life insurance and annuities, those are financial accounts too. And therefore, you have to treat those the same way you would have with any foreign bank account for your reporting requirements. Again, $10,000 or more in any foreign accounts, including the cash value life or annuity policies, and that's among all policies, not per policy. Yes? The one where they said that these life insurance policies and annuities were considered financial accounts?
Last year when I was looking at that to do the back compliance on our couple of clients, it seemed to be...
Well, it was more than a year ago. I think it was, my best recollection was at least 4 or 5 years ago. I actually remember getting the IRS memorandum talking about the clarification for the purposes of filing Form TD F90, which is the foreign account, 90.22.1. So if you go back in a couple of versions of that, I think it's, my best guess is it would at least before 2010, maybe as late as 2010, but I think it was earlier than that. So, and if you don't file those, the penalties, as you can imagine, are very harsh. I think they can be up to $100,000 per filing year, and they escalate based on whether it's a willful or honest omission, things of that nature. There's a couple of exemptions, at least under FATCA, and then not for the reporting of a foreign account, which is a $10,000 requirement, which is that certain cash value life insurance policies used to fund retirement plans and other savings plans where there's already some other reporting requirement under either ERISA or some other pension plan rule, and they're exempt. There's not a separate requirement under FATCA. And again, the main thrust of FATCA is to make sure that information is being shared with the U.S. government for the existence of these accounts and the attendant tax liabilities of those accounts. And for new entities, the requirements has been met starting this year, 2013. For pre-existing entities that were existed prior to this year, you have till 2015 to get into compliance. So you have a couple of years to go back to those old ones, and new ones have to be done essentially immediately. Now, I'm going to go into an offshore life insurance case study. Is anybody here familiar with what 412E plans are or welfare benefit plans? Okay. These are plans that are simply sold to business owners under the following notion. They say, you can put as much money as you want into this program every year. It'll provide death, disability, maybe health, medical expense reimbursement benefits to you, but the premiums are all tax deductible. So, and because it's all pre-tax deductible, you can buy a huge life insurance policy and invest in these programs on a pre-tax basis. And unlike pension plans, you aren't stuck with the pension contribution limitations that are imposed stateside. So you could put in, if someone makes $1 million for the year and needs $200,000 to live, they might put $800,000 that year into this plan and take a deduction for it. This looks pretty attractive on the front end. It's also in a trust, which is generally going to be considered to be asset protected and unable to creditors because it's providing for future qualified benefits. So you can see how to business owners that might be a very attractive proposition. There was a plan what I'll be talking about in this case study, but they use typically life insurance policies and annuities to fund these contracts for a couple of reasons. They don't have to. They could use a bank account. They could use mutual funds. But they typically use these investments for their tax deferral, and I think, frankly, more likely for the high commissions that they pay for selling the products inside these plans to these participants. So I'm going to mention IVUL, which is International Variable Universal Life, and also OVA, which is Offshore Variable Annuities. Those are the main funding mechanisms for these programs. So this is a case of United States of America versus Tracy Sunderledge and Maven and Randall Administration. Maven was an insurance program. They used, I forget the insurers, they come up in the complaint. They used some offshore insurers. Randall Administration, I believe, is also offshore. But the principals of all these companies were U.S. residents. So they gave the appearance of having offshore entities, but all the owners were U.S. people that mattered as far as the actual ownership of these assets. So that gave the U.S. Attorneys and office and other regulatory agencies, the SEC, obviously jurisdiction over them because they were on U.S. soil. So there was a complaint for permanent injunction against these companies for selling a non-compliant violative 412E plan. The 412E plan is the IRS section, Internal Revenue Code section 412E, which governs this type of a plan. 412E plans are, actually it should be 419, I think it's actually a typo. If you can make a note of that, please. The code section is 419. 412 involves life insurance in a pension plan. So the 419E was a single employer plan where you got one company in this group, so all the money is just there to fund future benefits for those employees or maybe just that owner of that business. You might have heard about 419AF6 plans, which is a second section of Internal Revenue Code, which talks about multiple employer plans where they put together a group of employers and they put premiums in, they share in the experience rating of these issues. Those were largely abusive. I think they were illicit transactions, at least for a period of time. But essentially, they were shut down. I remember when I worked for New York Life, they began marketing them back in the mid-2000s, early 2000s. And I was suggested that I should sell these, and I said, tell me about them. And they said, well, how do you get your money back if you have to lose your limbs or lose your eyesight or die or get disabled? What if someone just wants to retire and they put millions of dollars into the plan? And the training manager at New York Life, I won't say his name, said to me, well, Steve, just have your employer do an annually renewable employment contract, and when they want to retire, just don't have it renewed. Well, that's a sham, because the reality is the requirement under the code under 412E and AF6 is that there must be a substantial risk of forfeiture. In other words, you have to risk losing it if you don't qualify in order to get the tax deductions. So I will tell you, New York Life very soon after began pitching this program, they called it the STEP program, the Severance Trust Executive Pension, they called it. They had nice brochures. I don't think it was around for more than a year, and they yanked it. They stopped selling it because they realized this is a huge liability. Anybody in the room familiar with the Prudential structured sale transaction, which is similar to that? Prudential set up a company called Prudential out of Barbados, and they were setting up a plan where you're buying tax-deductible life insurance through installment sales of your company. So you'd sell your company, you would avoid the income tax on the sale because they would step in as the middle party and say, well, the buyer's giving us the money, we'll pay the money out to you over time in a structured sale, and that way you pay taxes only when you actually receive the money, and you can grow tax deferred for a long time, 10, 20, 30 years. Now, mathematically, that can work out really well for a business owner. What's the problem, though? Is that you're allowed to have a substitute obligor on an installment sale, but not from the beginning. So in other words, if I sold you my business, and 2 years into it, you said, I want to sell the business to somebody else, and I'm still owed another 8 years worth of payments, that new buyer is obligated to pay me those 8 years of payments. Just because you sold it doesn't get out of the obligation. However, you can't have that new person step in on day one and say, I'll hold the bag of money and just send out some pennies every now and then as you want them, and you pay taxes only that time. The IRS, as you can imagine, does not permit that, and they've won those cases when they brought them. So, sorry for the typo in the slide, I think it's only one. In this particular plan, the participants from across the nation have contributed what they believe to be almost $300 million in contributions to the sham plan. Now, how would you like to have one of your clients be one of them? And your client come back and say, hey, you told me this was good, or you didn't tell me it wasn't good, and I'm in this thing, and now the IRS is coming after me. More than a decade ago, the IRS ruled that the plan was a sham, did not comply with the rules, yet Sunderledge, he's the principal of the company, Continue to falsely claim in advertising to existing clients that it met all the requirements under the code, so people continued to make contributions to the plan, and they sold new plans. All right. Most of the funds are invested in offshore life insurance or annuity contracts, as I mentioned. Now, by the way, these excerpts in my slides are taken directly from the complaint for this case. I just copy and pasted them, so this is exactly what the the United States government has claimed based on their own discovery in the case. In addition to the Maven structure, Sunderland also sold asset protection and other benefit programs to employers. So you have these people that are essentially chronic tax shelter promoters. They sell these programs. They're not truthful about their qualifications in the U.S. code. However, they sound plausible. If you look at the code sections and read what they say, unless you really know how to drill down and look at what's happening in the courts, these plans might appear to be legitimate. So it really takes a professional person who's in the area to catch the con. You have to know someone who knows, well, but it doesn't meet this requirement, or the benefits are a sham because if you can get them at will, or other things where you can wink, wink, nod, nod, like I was saying before with the New York Life example, which I'm not aware they ever sold me like that, which is how it was suggested to me that I sell them. You can count on your client probably losing if you get a halfway decent auditor coming out after them when they realize all this money's come back to them and they're not taking it. Also, these plans are abusive. I mean, they're abusive plans like this, and these are all known by the IRS. Just listing the existence of the contribution on your tax return for your client might be enough to get the client audited. Okay, now obviously it goes without saying, what's the harm to the client? The harm to the client is, well, they didn't get the deduction. What I won't mention, what's not mentioned on my slide is they also maybe have been able to do other things that were illegitimate. But now you can't roll the clock back. I can't set up a defined benefit plan 4 years later and make 4 years prior contributions and take those deductions and amend my returns. The plan must be in existence in that tax year to get that deduction. So they're harmed actually more than just, this is again from the IRS, U.S. government slide, from the complaint rather. There's a lot of implications. And the implications can be huge. Can you imagine, let's assume for a second that one of us sold our client this transaction thinking it was legitimate. Okay? A few years later you find out it's bad news. Newspaper, your client gets audited, gets a notice, whatever it might be. Okay? Now what happens? The client says, wait a second. We did this instead of the defined benefit plan. I would have got a $250,000 deduction for the last 4 years. That's $1 million. I would have saved $300,000 in taxes. I would have had tax deferral. I'm going to sue you not just for the assessments and penalties here, but for what I should have done that you talked me out of. Can you imagine that happening? I can. And so it's not just what you did, it's also what you prevented someone from doing, or that they prevented from doing by being in the sham. So they can be harmed in some cases more than once by the same single transaction. In 1986, the SEC sued Sunderland in connection with his participation in an offering of a fraud. In the case, number is up here. Again, these are straight from the U.S. complaint. Now, that's a long time ago, right? What's it, over 20 years, almost 30 years ago? 30-something years ago. The court entered a permanent injunction enjoining him from future violations associated with any broker-dealers, essentially kicked her out of the industry. Didn't work, though, because he went on to lose new client funds long after that in the Madoff scandal, and he went on selling these programs after that. And in 2012, just last year, I got a call from a professional athlete through his financial advisor in Century City saying, we have an investment with our client, he can't get the money back, do you know about this? And that's how I know about this case. And so you look at 1986, this guy's bad news. The SEC sues him, that's a public record. Where was his advisor saying to him, hey, the guy behind this company is a con artist? Anybody here familiar with a company called Life Settlements, Inc.? LSI, they're a life settlement provider, you know who they are, Terry?
I believe so, yeah.
Big company would buy life insurance policies that seniors were selling for cash, rather than turning back. And my next section is on life settlements and Viaticals. So, but just a quick segue into this issue. That company was accused of stock manipulation and fraud, Life Settlements, Inc. Going back a step further, who was the original company? It was a company called Mutual Benefits. Mutual Benefits was also shut down by the SEC. Actually, I stand corrected. The first company, Mutual Benefits, was shut down by the SEC for stock manipulation and for doing some insider trading and things that were illegal.
Trials and pleas on that.
Still happening. So they changed the name of the company and set up another one. It's the same people behind it. This is no different. So if you just take a modicum of due diligence and step back and say, you know what, I'm going to assume that what you're saying to me is not true. Or be like Reagan, say, trust but verify. When you hear a great pitch and it all makes sense, and they have a nice brochure and a nice big law firm behind them, whoever the firm may be, it looks so good, you don't feel necessarily the need to go start poking around and asking questions and not trusting people. True? But the point is that when you say, maybe I shouldn't trust anything anybody says to me, and find out for myself and say, show me. If you had said to Bernie Madoff, show me that the money is actually in the account, that the trades are actually happening, and the earning returns you had, he would have said, if you need a verification, don't invest with me. Fine, I'm not going to invest with you. Because if you're real, you would have no problem. You'd be happy to show me. So asset protection is probably the last area, which I touched upon in my earlier slide on offshore life insurance and annuities. And again, the protection may be substantially better than having a U.S. company because you don't have the same, the judges don't have the same jurisdiction or access to turn the asset over as long as it's owned properly. But I would give you a note of caution, which is in the bottom of my slide, that it's my practice to have my clients own any investments, whether they're domestic or offshore, to own those investments in a trust, an offshore trust, which is a legitimate trust. They don't control the asset. They meet all the rules. It's not a wink, nod with a friendly trustee where it's done by the book. And in those situations, you can advertise when your client gets sued, hey, you're suing a guy who has most of his assets in an offshore trust. Trust has been in existence for 15 years. How are you going to collect? And that's usually enough to get the U.S. Local contingency fee attorney to say, you know what, I want your case, or pay me by the hour. And those cases often go away. So a great deterrent might actually be to advertise that you've done an offshore trust to the plaintiff when they're coming after you, as long as you've done it right. If you haven't done it right, then I wouldn't be advertising anything. Moving on to our second and last topic, which is life settlements and Viaticals. Now, we talked a bit about them before the session with this gentleman and a couple of others. But I'm going to talk about some of the abuses to the elderly and also the institutional frauds that happen worldwide in connection with life settlements and Viaticals. We're first going to talk about the one that happens to the client. Scheme number one is a no-lose proposition that was sold mainly from the early to mid-2000s through the late 2000s, where a senior qualifies for a large life insurance policy using what's called as their unused life insurance capacity. In other words, Mr. Smith, you're a wealthy man, you have almost no life insurance. I can get you qualified for $20 million of new life insurance. All you have to do is take a medical. I'll even arrange to have the premiums financed by a separate company. That's premium financed life insurance for the senior. After 2 years, once the contestability period for the policy has expired, where the insurer can no longer cancel the policy and say you made a misstatement in the application, for example, we'll then find a buyer, we'll sell it, and they'll make a bunch of money. And I've seen cases, I have about 90 of these cases nationwide right now, where in many of them there's written representation saying in 2 years, here's how much you're going to get. Whether it's an email or a pro forma, like a grid saying, if you get this rate or this LE at this life expectancy at this point in time, you'll collect $2.3 million after the premiums are paid off. So that's the incentive for the senior. So what happens is the agent makes that big commission I mentioned earlier today. Could be sometimes hundreds of thousands, if not millions of dollars in the first year. And then they have a hope of making money a second time when the policy is sold. If it's not sold, the agent still made the big commission up front, so what? The senior is left with nothing. So I have right now about 50 or 60 of those cases that are pending, many here in Florida, because you can imagine a lot of seniors are put through this stuff, and they're given this false promise, and then the market, quote-unquote, changed back in 2008 when the life expectancies changed, which is my next slide, and they're told this is the reason why you didn't get your money, it's not our fault. The market dried out, the credit crunch, and now the companies that provide the life expectancy reports saying how long you have to live, which is relied on by the buyer, because obviously if you're buying someone an insurance policy, first question is, well, how long I got to pay it for? If I'm buying a $10 million policy and I'm paying $500,000 in premiums, if you live 20 years, I'd give any insurance company all the money. If you live 10 years, okay, that's $5 million, I get back $10 million. So what's my rate of return? Well, look at your IRR calculation, it might be 8 or 10%. It's not such a bad investment. You down about sooner, it's a lot better. So in September and November of 2008, 21st Services, a private life expectancy provider company, and ABS, which is American Viatical Services, another counterparty company, revised their mortality assumptions up roughly 20 to 30%. So when we told you the guy had 10 years to live, it really should have been 12 or 13 years. So now the buyer says, I got to pay 2 or 3 years longer in the same contract to get my benefit, and my rate of return has just dropped. I'm earning less money because I got to wait longer to get it, and I got to lay out more premiums, which can be substantial. So it can make a good deal into not such a good deal, or even sometimes a loser. In January of this year, January 22nd to be exact, 21st Services again revised their assumptions upward another 30% for certain individuals, people that have healthy lifestyles, and just sitting on the couch and waiting for their arteries to shut down. So if you look at and they went up 30%. So if you look at the two changes in just 4 years, a little over 4 years, That's almost a 60% increase. So the guy who was going to live 10 years is now going to live almost 16 years. So you can see how that is essentially a type of fraud. I call it a fraud, it's a strong word, but I think it's a fraud because if you look at the basis for the representation when made in day one, this person's going to be dead in 10 years, not 16 years. What were you basing that on? What actual data or experiential data did you have before you put on a piece of paper and told the investor or told me as the investor that this is how long Mr. Smith had to live? And the reality was they had very limited sample data, and a lot of the data was actually skewed in the favor to make it look like people would die sooner to make these investments more attractive to the buyer. So there's your motivation. So scheme number 2 is when a policy is actually sold, but the commissions are concealed. And that's a rampant practice I've seen with essentially every life settlement company and a lot of the brokers, and indeed a couple cases in a second. So it's the perfect crime. Imagine being able to tell someone that the property sold for one price, you know it's sold for a higher price, and you and the broker to simply split the difference. In most states, until 2010, there's been no disclosure requirements. Now, it's a common law fraud, so you don't need to have that requirement to go sue somebody if you find out later. But you have no disclosure requirements. So they're telling the senior something that's called a net offer bid versus a gross offer bid, because there's a lack of transparency. So in other words, when your client sells their policy, they get a sheet saying, here's how much the purchase price was, whatever the number might be. That wasn't the purchase price. That was what they were going to tell you the purchase price was. It was really much higher, and the life settlement broker and your agent, who brought you this deal typically, or the agent who's involved, is pocketing sometimes several $100,000 or significant portions, as much as half or more sometimes. In these cases, I had a case against a publicly traded company that I was involved with. I sued them personally. I'm not going to mention the company, it's a confidential settlement, but I'll talk about the case quickly. They lied to me in writing on 4 separate emails about offering me my client's policy. And I lost the client in the deal because the deal went sideways. So I sued the company for my lost commission. My first and only life settlement transaction. I spent years talking about a lot of these things. So but I thought I could trust a big company, as you might imagine. It was a publicly traded company. I figured they wouldn't defraud me. And their subsidiary did. In discovery, I did what's called a class action type of discovery, where I actually requested all the records of all their other customers. They fought it, they opposed it in court, and they lost. The judge gave me hundreds of customer files. And they produced all those documents to me, about 20,000 pages. I read every one of them. When I went through them, I started seeing a pattern. What was the pattern I saw? The gross offer from Mr. Smith, $750,000. Offer to the customer, $500,000. It's a $250,000 commission. What did the agent do? He shuffled some papers and said, can you find me a buyer for this? So the question is, isn't the client entitled to know how much your property is worth? Now, this doesn't happen to your house or your car because you got comps for your house. You get Kelly Blue Book or Edmunds.com for your car. So you know pretty much what it's worth. So again, that's why I say it's a perfect opportunity for the crime. Also, there's been cases. There's one case in the middle here. It's going to be Coventry, where should be popping up here. Whoops, didn't come up backwards. I'll try it again. They, in addition to hiding the commissions, there's been cases where these companies have also gone so far as to suppress bids. So we were one bid for $700,000, one for $800,000, and the $700,000 bid, which in my example, this is the Coventry example, they said, don't relate or tell your client about the $800,000 offer. Instead, just present our offer. We'll give you $50,000. Shh, between us. Brokers were doing that. Spitzer found out about it and he sued them. They paid a $12 million fine in connection with that lawsuit. SEC versus Life Partners, which is a more recent case. That's the case I mentioned earlier, where the life expectancies, according to the SEC, were as much as 90 or 91% incorrect by year. So, and I've got that one client I mentioned before who was told he had 2 to 4 years for each of these individuals to live. So she thought by the 4th year, she would have collected some money in her IRA from these people dying. No one's died. And I got the agent to write an email, I call email evidence mail. In my email I caused him to write, I said, hey, tell us, why you sold us to the client. He said, well, I told her that some would die early and some would die late, and don't worry about the ones who die late, because the ones who would die early, and I had no idea that these life expectancy tables were so inaccurate. There's your case. If he didn't know, he couldn't have told her. If he didn't disclose any risk to the client, that there's a chance these people could live much longer, and what that would mean. She thought it would never happen because he told her it would never happen. So, someone, I think it was you or the gentleman in the back, mentioned earlier about the fact that can you still sue these people if they're bankrupt? Well, you have lots of different representations. Insurers can sometimes be held liable for the actions of the agent, depending on the state. And I'll go in a second, but let's talk more about the buyers now. So that's a seller getting ripped off. Let's talk about a hedge fund. But maybe your client's investing in shares. Ritchie Capital, this is a case from 2007 from Investment News, where Coventry First, same company again, you tend to see a lot of the same players here. Although in my experience, I've yet to find an honest one. Lost $700 million overnight when they realized that the life expectancies were grossly understated for all the policies they had bought from Coventry. I don't know the actual numbers, I knew at the time, but so when you go within 8 years, that's the average life expectancy for the group. It's 12 years. And Ritchie did not have the money in their fund, in their reserves, to pay 4 more years' worth of millions and millions of dollars of premiums. So what happened? They're bankrupt. Your assets are dwarfed by your liabilities. So you can see, and there's been offshore funds that have been subject to the exact same problems, and it really comes down to the life expectancies. The Life Partners case, guess who they used for their life expectancy provider? Their own employee, a doctor who they hired on their payroll, who said, oh, the guy's dead 2 to 4 years. It's funny, they're all dead 2 to 4 years, some 3 to 5 years. When you buy a proper commercial life expectancy, which is based on the client's medical records and done by an independent company with no financial interest in the outcome of that case, it says 108 months. And it's based on data, based on their model. It's very precise. And in some cases, SEC alleged that the doctor from Life Partners chose to ignore the longer life expectancies from these commercial companies and use his shorter one to sell the policies to investors. That's fraud, in my opinion. Now, who's legally responsible? Well, obviously the agent who got the client into the transaction in the first place. When I say agent, I mean the broker or the investment professional, the insurance agent typically. And also the E&O will often cover this activity. Even when the E&O policy says we don't cover life settlements, don't let that scare you, because that means a life settlement transaction. This was never a life settlement transaction. This was a representation to a customer about your policy will be worth X after 2 years. It's guaranteeing the value of the insurance contract. And a number of insurers have defended and settled those cases. They've not. So if you think there's no coverage, then you might be pleasantly surprised. Next, the life insurance company, agency or brokerage. Sometimes these brokerages are actually involved in getting their agents to sell these transactions, and they're aware of the representations. They're complicit. They may be considered aiding and abetting in the transaction, and so they may have liability. So if the agent's out of business and bankrupt and now selling used cars, you might still have the major agency who's still in business and has money and assets in E&O, who is a viable defendant, because it's often joint and several liability. So if one has no cash, the other one will have to pay. And they can fight among themselves later. That's the way the law in most states typically operates. The insurance company. Now, why would the insurance company be responsible if they didn't know about the representation? Well, in my state, California, under Insurance Code Section 1702.4, the insurer is responsible for the actions of the agent in connection with the policy and the application. Now, there's also a case called O'Riordan where if the insurance application contains misstatements, but the agent told the client that's how they had to fill it out, that the insurance company is imputed with the knowledge that the agent had, and it also won't get the insurance company off the hook. So the insurer is essentially profiting in some cases from these policies if they stay on the books long enough. And their agents are cloaked with authority. Let me ask you a question. If New York Life didn't sell you a policy, and actually they're a bad example, though I haven't seen them in these cases. Lincoln's a big player in these policies. Lincoln Insurance Company, it's Lincoln Benefit. They sell your client a policy, and the agent comes and says, here's your Lincoln policy, we'll sell it in 2 years. They're adding a little bit of a layer of legitimacy, aren't they? They're saying, this guy is good enough for us, he should be good enough for you. We're a $200 million life insurance company. So there are legal theories that can be advanced if the facts are right, to hold the life insurance company responsible, the agency and brokerage responsible if they were complicit in the transactions, surely the agent's always responsible. Sometimes the client doesn't want to the agent because his friend from the country club. Well, then here's the approach. You ask the agent, say, look, did someone talking me into this? Well, yeah, my buddy at the brokerage told me to do this. Well, and he gave me all the materials. And so, well, maybe we'll argue you're his sub-agent. And so we'll settle with you for 10 grand, a good faith settlement, we'll go after him because he got you in to sell it for us. And especially if that second agent typically is sharing in the commission. So you can start to see how you can start to branch out and make these people pay when the obvious target may not have any assets or any insurance to recover from. Also, the life settlement broker. If the broker is up front having the agents sell the policies to the customer so they can wait the 2 years and they can broker the deal, they may have some knowledge which could be enough for a trier of fact to find that they're culpable. And they could also be another course. So I will tell you, most settlement brokers are out of business, as Terry knows. A lot of them fold their tents. Business is down at least 80 to 95%. Your commentary?
Wrap their things up in arbitration. arbitration clauses with Minnesota law, which
It's not good for
totally
the...
void on this whole issue.
Right.
It doesn't have any.
Right. However, if there's any fraudulent inducement to enter into a contract, then the arbitration clauses are often thrown out. So as long as you can show there's fraud in the inducement of the contract, then arbitration may be ignored by a court, making drag them into court. And then lastly, a trustee or lender. I have found in a bunch of these cases the trustee is buddies with the insurance agent or somebody. It's not the client's son or their neighbor or a family member. It's often, I'll provide the trustee for you, I'll provide the financing for you, and here's the policy. That's how the agent sells these things. Well, the point is that you have an unfriendly trustee who's not going to sue himself. He's not going to say, hey, I got a kickback on a deal, I should have told you these things, because the trustee owes a fiduciary duty to the beneficiaries of that trust. So you have to tell me everything that's material. And all fiduciaries must do what? They got to tell you what their financial interest in the transaction is, and they have to advise you of the risks, and they're responsible the same way a lawyer is responsible to you, who owes also an independent financial duty to you. So we're covering the losses. I talked about some of the different theories to get back at these people. The statute of limitations is something you got to be careful of, because in most states, the statute of limitations, which is how long you have to sue once you find out, in some cases it's not this, it's called delayed discovery rule, can be as little as 2 to 6 years. Fraud in California is 3 years. Breach of oral contract is 2 years. So if you think about it, what are the causes of action typically? Well, breach of oral contract. He told me I'd be able to sell the policy in 2 years. Well, there's a problem with that. The problem is something called the statute of frauds. That's a legal theory which says that any contract to be performed more than 12 months in the future has to be reduced to writing. Can't be oral. So there's some ways around that based on the facts, which we can talk about privately, and I can help you with that. But you get the idea that there's always causes of action. You only need one to win a verdict in a case or make the defendant want to pay you and not go to trial. So you have fraud. They knew what they told me was false when they told me, and they did it to get my property, my money, which could also be the commission. 2, negligent misrepresentation. They made a statement to me that was material and that was false, and they had no reasonable basis to believe it was true when they told me. That one we have in almost every case. Because most of these agents are not crooks. They're not dishonest people. They're just greedy. And they're not very smart. And they typically don't ask many questions. They get pumped up at some presentation from their buddy who's making all this money all of a sudden driving a new car. And they start saying the same stuff too. And now they're making all the money. So they often don't, I don't believe most of these brokers intend to defraud these seniors. Or these, well, the hedge funds is a different story. I think that is fraud. Or at least gross willful negligence or misleading. That's the point on those deals. So if you're a trustee or know a trustee of an insurance trust where they were told you'd sell the policy in 2 years, there's something called a benefit of the bargain claim. Benefit of the bargain means even if the trust has no out-of-pocket, it was a premium financed, they borrowed the money, the lender's not coming after them, there's non-recourse, or the lender just chose to accept the policy, well, there's no damages, where's your claim? Simple. Your claim is, under most states, Florida recognizes it, California recognizes it, you're allowed to sue for what's called the benefit of the bargain. What was I told I would get, and what I have to do to get it? I was told I would get $2 million after 2 years on this $10 million policy, or 20% of the face amount. And all I had to do was stick out my arm, take a blood test, give a urine analysis, go through maybe an EKG, and wait my 2 years once the policy is issued.
Some
Yes?
have been dragged in that have damages because they've lost their insurable.
Well, that's a good point. I'll get that in a second, though. So, but I will come back to that. So the point is that for that person, if they got zero, and they're told they get $2 million, their claim is for $2 million plus interest. They don't have to have an out-of-pocket loss. Now, it's better if they do, because in some states, Florida has a higher requirement, but in California, you don't need to show mental incapacity. If someone is elderly, over 65 years old in my state, and they lose property, let's say they incur $20,000 in legal expenses, or $5,000 in attorney's fees or CPA fees setting up a trust. Now you've got another abuse claim, because they lost property, it's a requirement under California law at least, and they were deceived. Going to Terry's point, the point is very simply, well, what if the person now tries to buy new life insurance for some legitimate estate planning purpose? Well, this existing policy that's out there, or policies that are out there for all these millions of dollars, will be counted against them for how much insurance they can have, period. So let's say the client wants $5 million of insurance for his estate, but he's already maxed out from this transaction that didn't work out. The new insurer will likely say, you are declined, you've already spent all your insurance capacity. That cover good enough?
Yeah.
Okay, good. So the trustee should identify the claims or contact someone like me or a law firm who's familiar with life insurance cases like this. I'm not a lawyer, as you may or may not know. I run a litigation consulting company, a financial advisory company. However, I do work with lawyers all day long, and I also testify as an expert in cases. So I don't give legal advice. I'm telling you from my own experience. But obviously, my firm knows how to categorize these cases, work things up, and find people the right help, and we stay involved to the end of the case. And so when a lawyer's taking a deposition on a big case, I typically fly around the country and sit there with them, feed them questions on deposition, and make sure nothing is missed, among other things, including reviewing pleadings. We advise the beneficiaries of the claims. That's the first thing I do. Say, hey, I'm the trustee. I just found out that you actually may have a claim to get that money back, that you lost if it was cash loss, or the difference between what you were promised and what you actually received. And if it's cash loss, it's arguably both. Next, you have pursue the claim before it's lost. If you blow the statute of limitations, the trustee could also get in trouble for failing to advise the client that they had a claim. So now you had a pretty good claim against the trustee that he sat on the rights, and they just told him they would have gone after, or they would have replaced that trustee with somebody who would have. We're pretty good on time, actually. It's been exactly an hour. So my last slide just emphasizes the point, is that people have to act quickly on these transactions. And also, if you've got one of those non-compliant offshore life insurance policies, or you think your client might have one, you can call us. We'll go through it. I don't charge for an assessment of someone's contract. If I think there's a problem and we can help out, then we would have an arrangement with the client directly. But the bottom line is that it's doing the due diligence, doing the due diligence of these kinds of products and strategies up front can save you a lot of trouble later, and most of what you see out there is not as represented. That's in my experience in the offshore world, in particular when it comes to captive insurance, offshore life insurance, offshore annuities, because the money is so great, it sounds so exotic, it sounds so much better than what's available stateside, that typically the affluent client at a country club or at some other social setting is very easy prey. And Donald Trump had a great expression, which I love, which is, sometimes the best investments are the ones you don't make. And I have another one, which is it's easier to dodge a bullet than try to get one removed. And so if you think about it, this is a way you can help clients dodge bullets and say, maybe that offshore thing that sounds so fantastic is not what you're being told. Any questions?
Well, I've had clients that have been subpoenaed, and former guys that did this were subpoenaed in the securities fraud cases. It's a huge inconvenience to be pulled into something halfway across the country and be possibly named as a defendant, conspiring to violate, do a 10b-5 violation or something because somebody bought a portfolio of policies that aren't worth anything.
Right. Well, and it comes down to a basic question: what due diligence did you do before you bought the investment for me? And so the issue is, well, everything looked okay. They come legitimate. They had no lawsuits against them. But did you ever find out what the actual asset was? And who was doing these life expectancy reports? Because I showed you the major providers got it wrong.
And there's the IRS issue. They get the 1099s for the debt forgiveness.
Right. Well, that's interesting, is that there's two ways that the customer, the owner of the policy or the trust for the owner of the policy can get a taxable event without getting any money. One is, there's been some cases where the insurance companies will actually send a 1099 for the value of the insurance coverage. In other words, they impute the value of the insurance premium back to the trust and say, that's the value you received. Other times you've got what's called forgiveness of indebtedness or cancellation of debt, where the lender says, okay, we're going to forgive this loan. We're not going to come after you to collect it, but now you get a 1099 for $500,000 or $1 million or $2 million of income. And so that's a real insult to injury. Now the good news is, until the tax liability arises and is assessed, your statute of limitations do not begin to run. So if that happens, and the transaction was 6 years ago, and you have this tax problem that you just now find out about, then obviously you're okay.
Well, in some cases, they name their kids and their relatives as beneficiaries, and they got the 1099s on the trust.
Right. Right. So these things, as you can see, there's been a lot of havoc that's been visited on unsuspecting people, generally the elderly people when it comes to the failed life settlements, or the successful ones where they're hiding the commissions. And also, as you may imagine, you can't sue someone for something you didn't know about yet. So if you find out from my presentation, for example, you got a client you think who sold the policy and maybe they weren't treated fairly, let's find out. And we're able to go back and find what the policy actually sold for. And if it was substantially more than what they were told, many states have what's called a delayed discovery rule, which says that discovery doesn't start until you had facts you knew or had reason to know about the fraud. And if you just found out now, you had no idea this was even a pervasive practice, or had any reason to suspect it, I was just told that's what it's sold for, then that claim may still be timely. You may have still, if your state is, for example, I think Florida is 4 years for fraud, you have 4 years still from now. So anyway, any other questions on either topic?
Well, some of them are actually, another thing I'm coming into now is they told them, well, the market collapsed and we didn't get anything for your policy, but now we're finding out that the policies are being sold for substantial amounts of money from one fund to another.
Right.
I mean, and a lot of people were pressured into signing away any rights they had at the end of the term for that non-recourse loan. You know, some outfit named Cambridge.
I have them in a bunch of our cases, sure.
Cambridge and Phoenix Insurance. I mean, it's all, you know, they would get these pretty intimidating letters from these people. Well, you know, you need to sign these things. And a lot of them were told that they didn't have to make a decision on selling the policy for 7 years. They were told after the 2 years you can sell it or you can continue and we'll finance you for another 5 years with nothing out of pocket on a non-recourse basis. At the end of the 2 years, it's like, oh, the market collapsed, you got to sign this stuff over to us and surrender all your rights.
Right.
And then basically a year later, the policy is sold for
Right.
$500,000 over, you know.
That's a case where there may be something that can be done. You're describing a good situation. I appreciate the question, Terry, because that's something, or the comment, I should say. Also, the reason given why these policies couldn't sell, it's not always legitimate. Sometimes we're finding that we do a study of the actual policy. In other words, what did that policy cost in that individual? In the beginning, back in, let's say, 2005, when the agent sold it to him. He says, well, this policy will be worth in 2007, 2 years from now, X dollars. And we go back and say, well, based on the health and the cost of that particular life insurance policy, was that representation true even irrespective of any market change that happened after 08 when the tables got adjusted and the market crashed? And sometimes the answer is no, it was a non-starter. It was never going to sell, even under the pre-existing market terms. That's fraud. It's also potentially what's called the concealment of an action. You're concealing from the person the true reason why the transaction didn't work. It never could have worked. And why would the agent do that? Because he can make his insurance commission and perhaps make a second commission
We're getting more
later.
than 100% of the target premium.
Right. Yeah. So the way, if you ever see a life insurance illustration where it says target premium, target means up to that amount, it's fully commissionable to the insurance agent. Above that amount, the commission drops to a fraction. So when you see a target premium is, let's say, $300,000 a year and the client paid $350,000, the first $300,000 earns the agent a commission of 75% or more. So anyway, you can see it's a pretty peril-full area, both the offshore policies and also the life and settlements. Thank you all for coming. Appreciate it.